If the CEO of Universal Music Group would come into my room and punch me in the face, I would still buy more shares. That's how good this company really is. In this video, we're diving into the world's largest music label to see why UMG is one of the most reliable and underrated stocks in the world. I'll walk you through my fair value estimate to see if the stock at its current share price is priced at a discount or a premium. I'll also give my final buy, sell or hold recommendation and a final star rating of the stock as well. And to do that, we'll go through 4 key sections. But let's start off with the basics and go through why Universal Music Group is one of the most special companies in the world. Let's start by just looking at a few key numbers of UMG over the past year. We can see that revenue and EBITDA is up. We have a healthy EBITDA margin of 29%, and the current share price has actually lost 8% over the past year, which has given us an interesting valuation and opportunity to get in. The company is well headquartered in the Netherlands, but its operational headquarters is actually in California in the United States. So Universal Music Group is a global music powerhouse. It operates in 3 main segments. We have recorded music, that's the crown jewel. UMG controls a massive catalog of artists and earns royalties from every stream and album sale. We also have music publishing. This is about songwriting rights. UMG owns or administers over 3 million songs. Every time a song is covered, sampled or used in a commercial setting, UMG gets paid. And then we have merchandising and other. Think of artists' merch, live events and partnerships, and branded experiences. So the bull case for Universal Music Group are essentially 3 parts. We have streaming tailwinds. We have global streaming subscriptions that are growing, especially in emerging markets. We also have an unmatched catalog. UMG controls over 30% of global recorded music revenue, with long-term contracts locked with the biggest artists. And we also have a high margin business. Once a song is recorded, it can generate revenue for decades at minimal additional cost. Now, of course, nothing is perfect, right? We have a few risks. The first one is artist negotiations. Rising stars want more control over their music, and UMG needs to keep offering competitive deals. We also have platform power. Streamers like Spotify are trying to squeeze margins. If they gain too much negotiating power, UMG could take a revenue hit. And we also have a big one, and that is AI-generated music. The rise of AI tools that mimic famous voices and styles could disrupt the industry's economics and challenge copyright protections. Let's take a few seconds and listen to hedge fund manager Bill Ackman, one of the largest shareholders in UMG today.
The business is doing great. Earnings are up, well in excess of what we expected when we bought made the deal to buy the stock in August of last year, and just the multiples come down. It's trading at something under 20 times earnings for a business that we think can grow earnings at 20% or certainly high teens compounded for a long time in a really undisruptible business.
So now we have a taste or a flavor of what makes UMG so special. Let's move on to the financial analysis and look at some historical data that we have of the company. So as the company was listed in Amsterdam just a few years ago, we only have 4 years of financial data going back, but I think that's sufficient to tell the story. So let's start off with the core financial performance. Here we can see a few things. We can see that the revenue is growing nicely and consistently each year, and we can also see that the EBITDA is growing at 33% on average per year. That's much higher than the revenue growth, right? And that's been reflected in the margin. We can see that the EBITDA margin has gone from 13% in 2022 all the way up to 30% in 2024. Another interesting chart has to do with the debt sustainability to measure the risk of debt within the company. And here we can see really nice things. We can see that the debt, which is in purple, is going down, right? At the same time, the excess cash within the company is growing at 9% per year. The debt is going down at 15% per year. And that is reflected in the debt to EBITDA ratio. That's essentially how much EBITDA minus the excess cash that we need to pay down all the debt in the company. And we can see it's essentially at 0 times, which shows us that there is very little risk, at least in terms of debt, within the company today. Now, another amazing chart has to do with the enterprise value performance. Now, the enterprise value is, of course, the market cap plus the debt minus any excess cash. And we can see that here in blue. But the really striking thing here is the enterprise value relative to EBITDA as the enterprise value to EBITDA ratio. And we can see when the company was listed, it was around 30 times. But today, as the share price has barely risen, we can see that it has gone down to just 13 times. And that's incredibly attractive for one of the best companies in the world right now. Now let's also look at some interesting data related to the cash flow within the company, and it's telling us the same story as the EBITDA, right? The revenue is growing consistently and the free cash flow is doing the same thing. We can also see that the margin in terms of free cash flow is going up as well. It's all the way up at roughly 20% in 2024, and that's of course due to the free cash flow growing at a higher rate than the revenue growth at 12% per year. Now, the final chart shows us why this company is so much more attractive on a valuation basis. We can see the average share price here in the dotted line. It was 25 euros when the company was listed, and it's 25 euros still today. So in that sense, the company has grown its revenues, but the share price has remained flat. Also interesting to see here is the number of shares within the company, and that's the blue data here, that's in millions. And we can see that the shares are barely growing each year, showing us that the company is growing and it doesn't need to issue more shares and dilute shareholders as many other companies do. So we have gone through the amazing data behind Universal Music Group. Let's give the company 2 price targets before we move on to the valuation later on. And to do that, I'll start off with an enterprise value price target. And let's go through the assumptions here just quickly. So I'm assuming that until 2034, they will grow their revenues on average by 6%. That's half of what the company has done in the past 4 years in order to stay conservative. On top of that, I'm assuming that the EBITDA margin will continue to grow all the way up to 35%. That's slightly higher than the 29% in the company right now. Now, in addition, I'm also assuming a long-term enterprise value to EBITDA multiple of 15 times. In the past year, it's been 13 times, and usually when I do this, I assume a multiple that's lower than the past year, right? But I think 13 times, that's criminal. And to be frank, that's just too damn cheap for a company that's this good. So I'm assuming a slight multiple expansion in the coming years. Now, with all of that said, we get an enterprise value price target in the coming 10 years of 62 euros compared to the current share price of roughly 26 euros. As we now have an enterprise value price target, let's also do a free cash flow price target as well. And here are a few new assumptions. I'm assuming 8% yearly free cash flow growth all the way up to 2034. Now, in the past 4 years, that's been 26% per year. So I think 8% is quite conservative. Also, the free cash flow yield I expect to be 4.2% versus the 4.9%, so slightly going down. And yet again, going along with the theme of a higher multiple in the coming years. And also, I'm assuming that the share growth per year, that's the number of shares in the company, stays as it has done in the past 4 years. And with all of those assumptions together, we get a free cash flow price target in 2034 of roughly 60 euros. And that's in line with the enterprise value price target we just got before. As we now have 2 price targets, let's just weigh them equally, and then we get a weighted price target of 61.2 euros until 2034. Now, we need these price targets to know at what price we'll sell the stock in 10 years' time to estimate the annual compounded return we as investors might get. So now we've gone through the historical financial data we have on UMG, and we've given the company a weighted price target. Let's move on to the third part, which of course is the most exciting one, and see how undervalued the stock is really today. Now, if we discount all of the future cash flows that we estimate for UMG until 2034, we get a fair share price of 59 euros roughly. And that's a discount versus its current share price of 57%. And this also implies an annual expected compounded return that we as investors could get each year at 16%. And that's strong, right? That's above market returns, especially for European equities. And what also makes this quite interesting is that we're estimating revenue to just grow at 6% per year, which isn't that high, right? And still, we get a return of 16%. I think that's quite high upside versus the expectations that are in our case quite low for the company. Here are the estimates I have for the revenue and the free cash flow going 10 years ahead in time for UMG. Now, the big takeaway here has to do with the growth rates. We can see the revenue growth rate in orange as the dotted line and the free cash flow growth rate as the green dotted line. And we can see that the green dotted line will be slightly above the orange one, assuming that the company will be more profitable in the coming years, all the way up to 2031. then both growth rates will essentially be the same all the way up to 2034. Now with that said, we now know where the stock lies in terms of its intrinsic valuation. Let's conclude with a final rating of the company as well. Now, I've given Universal Music Group a final recommendation. Now, this is of course not financial advice, but I've given the company a strong buy and a 5 out of 5 star rating. So here we can see why the company has gotten such an amazing score. Looking at the financial performance, it has scored almost perfectly at each category. It has strong revenue growth, strong EBITDA, strong free cash flow, and low debt. Where it hasn't scored that well has to do with consistent stock performance. The stock has not performed in line with how the company has performed in recent years. That might be a bit concerning. Now, this might be due to the perception of the company. Some might view it as slow growth, old school company, but as you saw in terms of the valuation, where it also scored quite high, the company does not have to grow in the double digits to give us as investors a really good return on our money. Where the company also scores quite well has to do with strong competitive positioning. This is a company that owns roughly 33% of all recorded music in the world. That's strong competitive positioning. Thank you so much for watching. Please write in the comments down below, is there any other company you'd like me to value next? Also, if you go down to the link in the description below, you get the free one-pager with all the data I've gone through. So yeah, please like and subscribe. I'll see you in the next one.